last week in the S&P 500 we had some very mixed results right across the board, although if you were an investor who had a lot of stocks in the oil and gas industry, you would have been one of the better placed in terms of market gains, as we can see right across the board. ExxonMobil up 8%, we have Chevron up 4%, as well as other big names, in fact nearly up double digits. Now, one thing we need to be wary of is that the market has now entered pretty much towards the extreme greed center. In fact, it is sitting right in between at the 75 point. And if we just look over the last month, this was sitting in neutral. You do have to go back though to around a year before we saw extreme fear. Just something though to take in consideration, as market sentiment can change very, very quickly. Now, in today's episode, we are focusing on 8 undervalued dividend stocks to buy the dip, massive potential in terms of growth moving forwards. We'll look at each one's historical performance. We'll talk about their earnings, how they've been in the past, what management anticipate over the next 4 quarters. And we also want to run through the financial metrics that underline each company. We're going to look at the dividend safety, as well as other bits of information that do warrant your attention. For example, dividend yield theory, comparing the forward P against the 5-year average. And as we said, looking at what makes up each company, their free cash flows. We're going to talk about the ROICs and some important information that you need to understand before executing on these stocks. As always, we'll take a look at the valuation, give you our intrinsic value, how we got to this number. We'll talk about the margin of safety, 10, 20, 30%, that we do believe is attributable to each one. We'll also talk about the upside, whether or not it has sufficient enough for you to consider in your portfolio. But as we said, these are some very strong stocks to consider, and we do also hold quite a few of these within our own portfolio. Now, just before we get into these stocks, we want to let you know the earnings season is starting to kick back up in October. We have PepsiCo that are reporting before market open on Tuesday, and as we can see, quite a significant number of banks are reporting on Friday. As always, do make sure you are subscribed to the channel, as we do typically run through how the earnings have been for each of these big companies. Now, this week, a lot has happened. We have some very bullish news for the overall US economy. We see that private payrolls has shown better than expected growth in terms of the number of jobs creation for the month of September. As we can see, 143,000, a massive acceleration from the previous month of 103,000. And we also got the non-farm payrolls as well on Friday, which, as we can see, around 254,000. That is significantly up from the previous month of 159. So lots of bullish momentum for the US economy, as we've stated, which is good news if you are looking or in fact have investments in the US. And we also note from the last month, the US did have a fairly aggressive start, 0.5% in terms of the interest rate cuts, and with momentum gathering, we are expecting at a minimum in November either 25 to 50 basis points. It will be interesting to see what the Fed do, as we did see a very unexpected 50 basis points just last month. Now, getting into the first undervalued stock, it is one that we also hold in our own portfolio, Microsoft Corporation, with a double strong buy, that is from Wall Street and Quant. We also note a buy rating from Seeking Alpha. It is trading in the mid to upper end from the 52-week range. In fact, it has pulled back from the all-time high of $468, offers a forward yield of 0.8% and a forward PE of 31.6. Right now, S&P 500 sitting around 24 on a forward PE basis. And over the last 12 months, it is up 30%. Over the last 10 years, if you have been a shareholder, you would have significantly outperformed the S&P, up 850%. And as we go around and show you these for each of the 8 companies, understand it doesn't include those dividends reinvested. So if you have been, it would be up slightly higher. Now, in terms of their earnings moving forwards, they are anticipating 3 of the next 4 quarters to be double-digit EPS growth on a year-on-year basis. And we also note they have outperformed management targets. That is a 100% track record over the last 4 quarters. Now, if they do hit the June 2026 EPS estimate of 15.3, that forward P will come down to around 27.2, something that we do expect given they do have a fairly strong record of beating targets in history. Now, in terms of the actual company and the metrics, let's get into it. Dividend safety, 99, very safe, highest score obtainable, and we'll talk about these as we go into them. But we do want to point out something. Just last month, they did increase that dividend at 11%, something that we have come to expect given how consistent they increased those dividends at a double-digit rate. Now, it was reaffirmed in August, mid-August, in fact, that 99 safe score, ultimately meaning a dividend cut for MSFT is highly unlikely. We also want to look at each company's key metrics from the last recession, 07-09, and what we do in fact notice here, they maintained the dividend during that period. They didn't increase it, they also didn't cut it. They had average growth, -9%, S&P was around -11, -12, and they marginally outperformed, -48, with the S&P -55. As we already mentioned, double-digit dividend increases with this company is very typical, as we can see over the last 5 and 20 years, and they have also been increasing those dividends for the last 14. In terms of looking at this new valuation model, well, what this essentially compares is the forward P versus the historical performance. And when we zoom into the last month, the blue funnel essentially showing us the expected value or the intrinsic price. What we notice over the last 12 months, it has been pretty much trading above that fair value. Now it has come in to that fair value price, as we can see. But as always, we don't look at this model in isolation. We will come to our own valuation model shortly. We also look at dividend yield theory, which tells us a company is undervalued when the current yield is above the 5-year average. Given now 0.8%, not too far off the 5-year 0.91, we also note the forward P of 31.8 around the 5-year 31.3. This is a reasonable valuation signal, so that is two reasonable valuations, both on the yield and on the forward P. We do, however, note the information technology does sit lower at 26.5. Do remember though, we don't look at any one model in pure isolation. Now let's get to the free cash flow. It is one we will focus on these 8 companies, as earnings is susceptible to manipulation by management through accounting, and below 60% is the target. Does give us faith they can continue to offer those lovely double-digit increases we want to see from companies, and not just Microsoft. Not only below 60%, but pretty much every single year it has been reducing, at 30 in 2024, around 33 in the next 12 months. So we do expect these increases to continue. If you have been a shareholder, I'm sure this is something you do love about this company. And the free cash flow per share, we want to see consistent increases over the long term. It's more than tripled for Microsoft. We are starting off with a very strong company, and we do note over the next 12 months, this is anticipated to continue, $10.20 per share expected. Sales growth 3 to 7%, 3 to 4 at a bare minimum, just to keep up in line with inflation. They've been very strong, majority of the last 10 years double digits, 16% as we can see in 2024. In terms of looking at it from a numerical perspective, well, we do note it has nearly tripled, in fact more than doubled, 94 billion in 2015, 245 in 2024, and on top of those lovely increases to their dividend, they also return excess cash to investor pockets through those share buybacks every single year. Some years a little bit more than others, but overall it is a nice added bonus. In terms of the ROIC, which is pretty much our favorite metric out of all of these, where we want to see 10% or more to give us faith management are able to effectively allocate their capital, they do very, very strong double digits and pretty much increasing since the lows of 2017, 30% over the last 2 years. Does make this a very, very attractive proposition for investors who are looking to add, or in fact those investors who want to continue to add this company to their portfolio. In terms of increases to their top line, we also want to see increases to their margin, give us that operating efficiency sign, which Microsoft do, not only above the minimum 12%, but going from 30% in 2015, 45% in 2024. As we always say, this is a sure thing to know if a company is high quality, increasing revenue over the long term, as well as increasing margins. Free cash flow margin as well, consistently above 5%, consistently very strong as well. So another thing that we do love about this company in the portfolio. Net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. That is what we get every single year. As a reminder, this is one of the best balance sheets globally with the rating that it has. And these numbers below, as we can see here, show us the number of years it would take them to pay off all of their debt net of cash on hand. 0.17 in 24, 0.15 over the next 12 months, just goes to show that it is very, very strong. And as a final point for this metric, it does correlate to both dividend safety and balance sheet strength, so very important within our own analysis. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $461 in today's episode. As always, when we do our deeper dives, we do run through every single one of these models, inputs, outputs. Today we're going to get straight to it. At 461, we always like to use a margin of safety, and we use 10% as a starting point. Execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Now this is one that you could actually look at Microsoft and say it does hit these criteria and it is a buy at 10%. What we also notice, Wall Street, where we did see the strong buy rating alongside quant, believe the target price over the next year, $503, and they see upside of 21%. They do believe this company will be a massive benefactor for the AI revolution that we are seeing today. For those that believe it is a strong company but want a higher MOS, well, at 15% a buy at 392, at 20% around 369, and at the 25% around 346. However, as we said in today's episode, 10% MOS, and as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Microsoft or any others. And also, do give us your thoughts as we go along each one in today's episode. Now, before we continue, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning where we take a look to see what's happened in the market over the last few days. For example, in the more recent article, we talk about 3 stocks that we are buying in October, and you can click on the pinned comment below, sign up and read straight away. On top of that, by doing that, you will be able to get access to 36 undervalued dividend stocks for the month of October. We run through each one, a lot of information, as well as talking about those that sit within our own portfolio within this group. On top of that, you can grab 22 undervalued dividend stocks that Wall Street believe have the most upside out of the whole S&P 500. So do click below, sign up, and you can read straight away. So the next company we have is Merck Co with a double buy rating and a hold from quant. This one is a 4.48 out of 5 for Wall Street, so pretty much borderlining a strong buy signal from them. It does trade down the lower end of the 52-week range with a forward yield higher than Microsoft, 2.8%, and a much lower forward P at 13.5. Over the last year, it has lagged the S&P, up 7%. Over the last 10 years as well, up around 90%. Now, in terms of looking at this company and their earnings, we do notice the next 4 quarters, 3 of them, they expect growth. They have the next quarter with negative 17% EPS year on year. What is nice to note, though, over the previous 4, they do have that 100% track record, and December 2025's EPS estimate of 9.77 will lower that forward P down to 11. Now, in terms of dividend safety, another very safe score at 90, and we also get an above inflationary increase to the dividend last November at the 5.5%. Remember, that does mean that we are anticipating another dividend increase just over the next few weeks. In terms of last recession, well, they maintained the dividend. They had negative 4% recession sales, and they pretty much trailed the S&P, although very marginally at negative 57%. In terms of dividend growth, we already seen last year, but nice to report over the last 5 years, on average, very high single digit at 9%. Over the last 20 though, at least at the bare minimum, keeping up in line with inflation at the 4% point. We do know they have 12 years of consecutively increasing those dividends, with 53 years of paying a dividend without a reduction. Now, when we do look at this valuation model and zoom in particularly over the last 12 months, we do note, similar to Microsoft, over the last 12, it has been trading towards the upper end, if not higher than the expected fair value. According to this, right now, it does sit within that blue funnel. Now, when we look at dividend yield theory, we do get another sense of reasonable valuation. The yield not too far off the 5-year rolling, and the same to be said for the forward PE. However, in comparison, it does actually sit lower than the healthcare sector, which sits at 16.4. Now, when we talk about the free cash flow payout, very, very inconsistent. We want below 60% pretty much every single year. Over the last 12 months, well, 81%. Positive to take, though, over the next 12, coming down to the 37 percentage point. Free cash flow as well, it has nearly doubled over the last 12 months, but we also get inconsistency, and we note pretty much over the next 12 months, it is expected to more than double to 836. Sales growth, again, inconsistency showing. 3 of the last 10 years have in fact been negative, although the last 4 years have been a lot more positive. 7% we do note on a trailing 12-month basis, which shows us over the last 10 years, it has pretty much increased by 50%. from 40 billion to 60 billion in 2023. In terms of share buybacks as well, we do notice some returning of excess cash, although over the last 4 years it hasn't really been anything. So again, whilst it is a nice bonus, not too much to discuss for Merck Co. ROIC, nice to note, not only increasing but also very high, 21% in 23, 24 on a trailing 12-month basis, so it does tick off that box on what we already have said is a very, very important metric. In terms of the margins, well, above 12% is what we note, and in fact increasing, so operating efficiency, 32% on a trailing 12-month basis is very good to see, and free cash flow, no issues whatsoever. Pretty much the common theme of this company, whilst it is inconsistent over the longer term, nonetheless the numbers still look very, very strong. In terms of the net debt to EBITDA, well, below 3 is what we get, and from the very high movement from 0.7 in 22 to 2.81 in 23, nice to note that it is anticipated to come down sharply to 0.87 over the next 12 months, which is why we still see that very safe dividend score of 90 for Merck Co. In terms of our intrinsic value, we're $146, marginally higher than Wall Street of 141. They also note 29% upside, which is very attractive to consider for a company. And when we do run it through the MOS calculation, at 10% a buy at 131, at 20% around 117, and that the 25 percentage point is where we see this company right now. For a lot of people, this may not be an industry they consider. For others, 25% MOS, 29% upside may be one to really consider. And if you do want us to do a deeper dive on any of these today, do let us know below and we can take a look, looking at more than the information that we have seen in today's episode. We then move on to GPN Global Payments with a double buy rating and a hold from Quant. This one's similar, trading towards the 52-week low. It has a yield just above the 1% point, a forward PE very low at 8.5. Over the last 12 months, down nearly 13%. Over the last 10 years, it still has outperformed the S&P, up 169%. Although we do see all-time highs over $200 and over 3 years ago, right now it is trading, in fact, less than half of that at the $99 mark. In terms of earnings, well, very, very positive to see over the next 4 quarters, double-digit increases to the EPS anticipated. Over the last 4, they have also outperformed, so a very good model student that we can see here for GPN. December 2025 EPS estimate will also lower that forward PE to 7.63. In terms of looking at the information, well, dividend safety is 70. The thing that a lot of people will not like is that they haven't increased their dividend for a number of years, but when we do come to look at the metrics, it does look very strong. In terms of dividend safety, well, given it is safe, it ultimately means a dividend cut is unlikely. Then we get to the key metrics where we can see they maintained the dividend during the Great Recession. They actually had positive sales, plus 7%, and they also outperformed the S&P, negative 38%. As we said, we haven't heard an increase in quite some time, but over the last 5 and the last 20 years, they have still averaged a double-digit rate over the period, and therefore, whilst there is 0 years of consecutive increases, they have paid a dividend without a reduction for the last 22 years. Now, looking at that forward PE, we do get an undervaluation signal, but what is interesting to note is that over the last year, this company has been trading at quite a substantial discount to the expected fair price. We can also note a double undervaluation signal. The yield is higher than the 5-year rolling, and the forward PE does sit below the 13.5 5-year average. On top of that, it is also lower than the financials of 12.3 as a sector ratio, and that is interesting because today's episode for GPM, we get a quadruple undervaluation signal. Now, in terms of free cash flow payout, it has been below 60% every single year and by quite some distance, which does go to show us that if they wanted to, they could increase this dividend by quite a dramatic rate. However, it doesn't seem to be one of their main priorities. 16% in 23, 9% over the next 12 months. As we said, if they want to, they could, just not something right now it is their priority. Free cash flow per share, well, increasing as we can see, more than double over the last 10 years. Fairly flat though over the more recent period. Nice to report nearly double growth anticipated to $11 per share over the next 12 months. Sales does also look good, whilst it is inconsistent. When you take a look at this percentage format in terms of its numericals, what we can in fact see, it has more than tripled from 2.8 billion in 2015 to just under 10 billion in 2023. Now, this company is fairly interesting when we look at these shares outstanding. They've actually diluted your position as a shareholder from 2015 to 2020. But what we do note from the massive increase from 2019 to 2020, they have started to do some share buybacks on a fairly consistent basis over the last few years. So maybe that is what they are focusing their priorities on. Rather than through the dividends, they are focusing heavily on those share buybacks. In terms of ROIC, as we said, 10% or more, not something that we have seen here. In fact, from 2019 lows of 2%, it has started to increase 5% over the last 2 years, 6% on a trailing 12-month basis. Again, just something to monitor and maybe factor that in when we do come to that margin of safety. In terms of operating margin, well, above 12% is what we get. Again, fairly inconsistent, but from the COVID lows of 12%, it has started to increase 24% on a trailing 12-month basis, looking fairly respectable, as well as the free cash flow, no complaints whatsoever, looking very, very strong on a year-on-year basis. We then get to the net debt to EBITDA, where we do ideally want to see below 3, not something we see that consistent, in fact, not that often. 3.55 in 2023, 3.3, so a drop anticipated over the next 12 months, but not enough to come below that 3 that we ideally want to see on this channel. In terms of the valuation, well, our intrinsic value of 139, pretty much spot on with Wall Street of 139 over the next 12 months, where they see a whopping 42% upside, which means it does look like a contender to seriously consider if it does fit within your own portfolio and your overall investment thesis. In terms of margin of safety then, at 10% a buy at 125, at 20% at 111, and in today's episode you are pretty much getting a 30% margin of safety, with Wall Street, as we said, declaring this a very good buy and one to seriously consider. As always, do give us your thoughts in the comments below. Let us know whether or not any of these are a buy, hold, or sell for you today. We then move into the tobacco industry with BTI, British American Tobacco, where we get a buy from Seeking Alpha. Again, not too far off a strong buy from them, with a hold from Wall Street and Quant, trading in the mid to upper end of the 52-week range, with a yield looking attractive around 8.5%, forward PE of 7.5, and over the last year it has started to climb up around 17%. Over the last 10 years, though, we do notice it is down around 36%. Bear in mind, though, this doesn't include those very high yield dividends reinvested. Then in terms of looking at this from the metrics perspective, we do get a borderline safe score that we can touch upon at 45. We have that undervaluation signal with a fairly mediocre increase in February this year. In terms of dividend safety and what this means, ultimately there is a moderate risk of a dividend cut over a full economic cycle. Last recession, though, they increased the dividend. They had plus 5% sales and they massively outperformed the S&P, negative 31% return. Now 2% in February, 3% over the last 5 years, though, although over the last 20, we do see that 9% year on year. We also note 24 years of consecutive increasing the dividend, so if they continue that next year, which we do anticipate they will enter that dividend aristocrat status. As we can see here, over the last 12 months, it has been trading severely below that intrinsic value. Only over the last few months has it really started to come right towards the bottom of that, and we will come to a very similar conclusion when we do look at it from our valuation perspective. We also note double undervaluation signal, 8.42 above the 5-year rolling, as well as the forward P, 7.4 below the 8.3. When we look at it as well, significantly lower than consumer staples at 17.7. In terms of free cash flow payout for tobacco industry, we do bring this to around 85%, pretty much below that every single year, especially the more recent years, 51 in 23, 61 over the next 12 months, so no worries whatsoever so far. Free cash flow per share has also been increasing, in fact nearly tripled over the last 10 years, although we do want to point out over the next 12 months it is anticipated to drop to 366. We also note their sales growth has been very, very inconsistent, and we do note over the last 12 months and on a trailing 12-month basis, we do see negative, and a lot of people do believe this industry is starting to die out, which is why they have diversified into other areas within the same industry. We also note total sales has pretty much doubled over the last 10 years, but when you really look at the more recent year, it has started to be flat, not much growth has been seen, and not a lot of growth is anticipated moving forwards. Just something to bear in mind. And they've also diluted your position over the last 10 years as a shareholder, although we do note from 2021 they have started to do some very, very trivial buybacks year on year. We then move on to the ROIC, which as we can see here, above 15%, so we bring it higher for tobacco companies. They haven't achieved that for around 7 of the last 10. 12% in 2023 is looking good. Ideally, they can move on from this and go higher up to the levels we have seen in 2014 to 2016. Operating margin, typically this is what we do expect from this industry, above 25% for tobacco. We also note some operating efficiency over the last 10 years, and the same to be said for the free cash flows, looking very strong, a free cash flow machine, so that is some positives for this company. And the net debt to EBITDA, around 3 is what we want to see for tobacco, 2.65 in 2023, a little bit lower over the next 12 months. So based on this information, if they can keep this up, then the dividend does look to be safe. No red flag indicators so far based on this information. Now, our intrinsic value of $47, we can see it is higher than Wall Street. They have $41 where they believe 17% upside, which is nice to know, especially for a company that is paying you a very high yield as well. In terms of the MOS, well, at 10%, a buy at $42, at 20% at $37, and at 25%, pretty much bang on right now for BTI. 25% MOS, 17% upside. I know a lot of people in this community have been buying British American Tobacco, and others have been also buying Altria. Now for me, out of these two, I am invested in Altria Group. It has a very, very similar yield, but the one thing when we have looked at the metrics, Altria has looked a lot stronger, although this is purely just my own opinion. We then move on to Visa, which is one I do hold in my own portfolio, with a double buy rating from Seeking Alpha from Wall Street, a hold from Quant, trading at the upper end of the 52-week range, although it has pulled back from the all-time high of $293. Forward yield 0.75%, forward PE 28.03, and over the last 12 months, it is up 20%. Over the last 10 years, significantly outperforming the S&P, up 438. We also note over the next 4 quarters, 3 of them anticipated double-digit growth. Nice to report, either in line or beating expectations over the last 4 quarters. Also, EPS growth anticipated, bringing down that forward PE to 25.1 in September 2025. Also great to see a 99 very safe dividend score, and we also got that very nice double-digit increase to the dividend in October last year, meaning we are anticipating a dividend increase from Visa over the next few days. In terms of the last recession, well, they did increase the dividend, and they also had plus 10% recession sales, which is very strong. Remember, the S&P had negative 12. No surprises then, we are expecting a double-digit increase to the Visa dividend this month, given how essentially consistent it has been over the last 10 years, and we also note they have been increasing those dividends for the last 15. Now, in terms of this valuation model, when we do zoom into the last 12 months, we can see it's pretty much been trading right towards the lower end of that expected price, which does mean there should be some value in this very high quality company today. In terms of the dividend yield theory, well, as we can see here, marginally higher, so we would just say reasonable valuation. We do, however, note the forward P of 25.9 is below the 5-year rolling of 27.9 and significantly higher than the financial sector bucket of 12.3, but we personally believe Visa does deserve this premium. Whether or not this is too much of a premium in today's episode is something to consider. Free cash flow, well, below 60% consistently. No surprises given how consistent they are in increasing those dividends at a double-digit rate. 21% expected over the next 12 months. And free cash flow looking very strong, as we can clearly see here, more than tripled over the last 10 years and expected to increase over the next 12 to 998. In terms of sales growth, well, literally nearly double digit to the top line every single year. We have that justifiable COVID year in 2020 at negative 5%. And when we look at it from a numerical perspective, well, they've nearly tripled their top line over the last 10 years. And also very consistently, even though fairly small, been doing those share buybacks, which is great to see from a company, not just share buybacks, but also on top of that, giving that double-digit dividend growth, ideally what we want to see from companies we are investing in or considering. No issues to note with the ROIC either, looking very, very healthy, increasing from 2020 lows of 21%, 34 in 23, 36 over the trailing 12 months. In terms of margins as well, not really going to find a company that has as good or if not better. Above 12% is what we see, 67% over the last 2 years, and the same to say for the free cash flow margin, looking very, very strong. This is definitely one we would consider for everyone's portfolio alongside MasterCard. Net debt to EBITDA as well, we do note this very low every single year, 0.05 in 2023, 0.14 over the next 12 months. It wouldn't take them that many days to pay off all of their debt net of cash on hand. A very strong balance sheet. Now, our intrinsic value of $323 with an MOS of 10%, it is a buy up to $290 at 15%. We're talking a few dollars shy, so we do believe Visa is near a 15% margin of safety, which looks very good for a high quality company. Wall Street, although a little bit lower, still $317. They see upside of 14%, making it one that you should consider for your portfolio or have it on the watch list for a price that does suit your thesis. We then move on to Honeywell International with a double buy rating from Wall Street and Quant. We do get a hold rating from Seeking Alpha, trading in the mid to upper end of the 52-week range, a 2.23% yield, a 20 forward P, and over the last 12 months up 12%, although lagging the S&P. Over the last 10 years up 130%. In terms of their earnings, well, nice to report that over the next 4 quarters, they expect 3 of them to be double-digit increases to the EPS, and the last 4 they have outperformed analyst targets. With December 2025 EPS estimate of 11.1, that forward P will come down to 18.18. Nice report, the best dividend safety score at 99, very safe, and just last month they did increase that dividend marginally higher than essentially inflation at that 4.6 percentage point. In terms of last recession, while they increased the dividend, they had below average growth and they marginally trailed the S&P at negative 60%. As we can see, around an inflationary increase to the dividend last month, 6% over the last 5 years, 9% over the last 20, and they have been increasing those dividends for the last 13 years, whilst paying a dividend for the last 31 without a reduction. Now, in terms of that valuation over the last year, pretty much trading towards the bottom of that consistently. Right now, we can see that same conclusion. And when we look at dividend yield theory, we do get that double undervaluation signal, with both the yield being higher than the 5-year and the forward P being below the 5-year 21.4. It is pretty much marginally lower than the industrial sector as a whole of 20.8. Now, free cash flow payout below 60% is pretty much what we see every year, bar 2023, but expectation is that it is coming down to 54% over the next 12 months. Now, free cash flow hasn't been consistently increasing over the longer term, but we do notice growth from 2014 to 2023 and a nice jump expected over the next 12 months to $8.32. In terms of sales growth, well, 3 of the last 10 years have been negative growth, but we can pretty much see, other than that, this is a company that does have sales around that 3 to 7 percentage point that we look at, and we can clearly see here it has struggled to increase on a consistent basis, but from the lows of 2020, it has started to pick up, and this is one that we would expect to continue gradually increase over the period. They've also done some nice share buybacks from 2014 to 2023, 795 down to 660. It is definitely one of their priorities and something they do consider very important when they do look at their capital allocation. No worries whatsoever with the ROIC, very consistent in the high teens, low 20s year on year, and that is something that we really do like to see from companies. Operating efficiency noted as well, 14% margin in 2014, 21 in 2023, and we can clearly see the increases on a year-on-year basis. Free cash flow margin looking very strong as well, 12% in 23, 15 on a trailing 12-month basis, so no complaints whatsoever. And also a fairly strong balance sheet, good net debt to EBITDA level, 1.41 in 23, an increase anticipated of 1.77, but still below the maximum 3 that we want to see for companies to consider. So in terms of our valuation, well, at $224, it is lower than Wall Street. They have a $235 price target where they see 16% upside. And in terms of our margin of safety today, well, we do see it at that 10% level around $202. For those that want it at the 15% around 191 and at 20% around 180. But as we said, today's episode, 10% MOS with 16% upside according to Wall Street. We then move on to another company I do hold in the portfolio. It is the Railroad Union Pacific, UNP, with a double buy rating from Seeking Alpha and Wall Street, a hold from Quant. Trading in the mid to upper end of the 52-week range, it has come down from its all-time highs of $259. 2.24% yield, 21.46 in terms of the forward P, up 18% over the last 12 months, over the last 10 years up 137%. In terms of EPS growth expectations, they are expected continued growth. Bear in mind this is a fairly cyclical industry. Over the last 4 quarters as well, they have outperformed analyst targets, and ultimately EPS growth is what they expect, bringing their forward P to 19.2 in December 2025. Great to see quite a lot of very safe dividend scores today, so very nice to note, although we are disappointed with their dividend increase of only 3.1% in July this year. In terms of the last recession, while they increased the dividend, they had negative 21% recession sales below the S&P, and they marginally outperformed negative 42%. As you can see, while we are very disappointed this year, 3.1, when historically we have seen some very strong double-digit growth year on year, and we do note they've been increasing those dividends for the last 17 years, whilst paying a dividend for the last 25 without a reduction. Now, when we look at it based on the yield, we can see pretty much the majority of the last 12 months trading within its fair value, right now though towards the mid to low end of that point. In terms of dividend yield theory though, we do get a marginal undervaluation signal on the yield, as well as pretty much reasonable valuation on a forward PE perspective. In terms of the industrials as a whole, we do note Union Pacific pretty much in line, 20.6 versus 20.8. In terms of the free cash flow payout, well, below 60% is what we get for the majority of the last 10 years, and we also note over the next 12 months expected to come down to 53%. Free cash flow per share as well, we do note it has pretty much doubled over the last 10 years, with growth expected to continue quite substantially over the next 12 months to $10.10 per share. As we've already mentioned, a fairly cyclical industry. In fact, 5 of the last 10 years, including 2023, have been negative. And when we do look at it from a numerical perspective, we can see that played out in the numbers. One thing that we do love about this company is returning of excess cash to shareholder pockets through those share buybacks on a year-on-year basis. Always great to see, and especially nice to note given how disappointing that dividend increase was in July this year. ROIC though consistently looking very good in the mid-teens, 15% in 23, as well as on a trailing 12-month basis, and their margins are very, very high, so that is something we quite like to note from a company. 36% in 2014, 38 in 2023, and no worries whatsoever with the overall free cash flow margin year on year. Now, net debt to EBITDA has been increasing from 2014. That is one cause for concern. Hopefully, we can see over the next 12 months, they do hit the expectations of lowering it down to 2.45. In terms of the valuation for UMP, $258. Now, we pretty much see around a 10% margin of safety up to $233. At the 15% around 220, at 20% around 207. So right now we see around 10% MOS up to a few dollars shy, but will depend whether or not this does fit your overall thesis. The company is one you want to consider, and whether or not the margin of safety in today is something to add on to the watch list. We also note though Wall Street are in disagreement. They believe the price over the next year will be a lot higher than our intrinsic value, and they see 16% moving forwards. Do let us know, as a lot of people do prefer other railroad companies, whether that's CP, CNI, NSC, and many others. We then move on to a real estate investment trust, one we haven't covered in a while, and actually one we also hold in our own portfolio. That is Stag Industrial, with a triple buy rating right across the board, trading pretty much in the midpoint of the 52-week range, a forward yield of 3.93%, a price to funds from operation of 15.7, and over the last 12 months, up 11%. Over the last 10 years, as we can see, up 78%. All-time highs, though, we do note sitting December 21 at $48. Now, they are expecting growth over the FFO over the next 4 quarters, and we can see they've outperformed over the last 4, and they do believe the funds from operation will increase, lowering the P to FFO to 15.01. Now, we do know the dividend score sits at 60, borderline safe, and they did have a very mediocre increase of 0.7% in January this year. Just as a reminder, dividend safety score at borderline means there is a moderate risk of a dividend cut over a full economic cycle. We also note they had average recession sales of negative 12%. This is a company that you have to bear in mind has fairly poor growth over the last 5 and 10 years, as we can see below the 4% inflation level, and they've been increasing those dividends over the last 12 years. Now, in terms of looking at the valuation on the P to AFFO perspective, over the last year, it has been bouncing from the upper end to the lower end, right now sitting somewhere in the middle. And from a dividend yield perspective, we can in fact see it is marginally lower on the yield and pretty much in line on the forward P to AFFO, giving it that reasonable valuation and just marginally higher than sector of real estate at 16.9. So what about the payout ratio? Now, important to understand, for REITs, a lot more volatile in terms of the free cash flow. So we draw your attention to the adjusted funds from operation. Below 75% is what we want from industrials. Not something they have hit consistently. Nice to report though, 2023 at 73%, over the next 12 months at 70% is a good sign moving forwards for the expectation of nice dividend increases from this company. In terms of the adjusted FFO per share, we do want to see consistent increases over long term, which is pretty much what we get other than COVID 2020, and expectation moving forwards to 12 for Stag Industrial. In terms of sales growth, well, for REITs, we want 5 to 10%. It is what we see on a year-on-year basis, although it is starting to slow down. Nice to report 9% on a trailing 12-month. Hopefully, we can get it back up to the double digit we have come to see regularly from this company. In terms of numericals, though, we can see it has been increasing at a very rapid rate. And one thing we always have to point out with REITs, they will dilute your position over the longer term, some quicker than others. Main reason, as we can see here, they don't retain a lot of that internally generated cash flow, as they do pay the majority out here as dividend. ROIC for normal companies, 10% or more. For REITs, 3 to 5%. That is where they are sitting at right now. And in fact, it has been increasing over the last 10 years. Hopefully, we continue that trend into 2024 and beyond. In terms of the operating margin, strong operating efficiencies going from 14% to 34% in 2023. So that is a very good sign to note. And net debt to EBITDA below 5 for industrials. That is where it's sitting at right now, but as we can see, it has started to decrease, was fairly high back in 2015. Nice report over the next 12 months. Expectation is for this to come down, and hopefully that will bring out a higher dividend safety score moving forwards. In terms of the intrinsic value, well, $42, marginally lower than Wall Street, and they have $44 with upside of 17%, as we can see here. And when we do look at the margin of safety, well, at 10%, a buy up to $37.53, which is pretty much where we see this company right now. Now, there are lots of good REITs to own, especially with interest rates that seem to be coming down over the next few months. This is one to consider. We do also like Vici Properties, which we hold, as well as Realty Income and lots of others in this sector. As always, though, do give us your thoughts. Maybe you want us to do a deeper dive into some other REITs. Maybe you have some other companies that you do fit the bill for today's episode. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below. We are releasing a next edition on Monday morning. And as always, come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.